Why do some stocks go up while others go down? This question puzzles many new investors. Two companies can have similar fundamentals, yet their stock prices behave differently. The market can be a confusing place. Understanding the underlying reasons can help clarify these price movements. One reason is the concept of intrinsic value. It is a key factor that influences stock prices. Knowing about intrinsic value can provide insights into these mysteries. It can help investors make better decisions. Intrinsic value might seem complicated at first. However, with a simple explanation, it becomes easier to grasp. This guide aims to unlock the hidden value of stocks. By understanding intrinsic value, you can enhance your investment strategies. This knowledge can lead to better financial outcomes. Let's dive into what intrinsic value truly means. Intrinsic value is the true worth of an asset. Think of it as hidden treasure. It is the real value that might not be immediately visible. Unlike market value, intrinsic value is based on fundamental analysis. Market value is what buyers are willing to pay. It can be influenced by emotions and speculation. In contrast, intrinsic value relies on objective factors. These include a company's earnings, dividends, and growth potential. Imagine buying a house. The market price might be high due to demand, but the intrinsic value is based on the house's structure, location, and amenities. Similarly, a stock's intrinsic value is based on its fundamentals. Understanding intrinsic value helps in making informed investment decisions. It reveals whether a stock is overpriced or underpriced. This can be crucial for long-term investment success. Intrinsic value is not always easy to calculate. It requires thorough analysis and understanding of various methods. Let's explore why intrinsic value is so important. Intrinsic value plays a crucial role in investing. It provides a deeper understanding of an asset's true worth. This helps investors make rational decisions. Knowing the intrinsic value can prevent impulsive buying or selling. Firstly, intrinsic value helps in identifying undervalued stocks. These are stocks trading below their true worth. Investing in such stocks can lead to significant gains. It is like buying something valuable at a discount. Secondly, intrinsic value helps avoid overvaluation. Overvalued stocks are those trading above their true worth. Investing in them can be risky. It is like paying too much for an item that isn't worth the price. Thirdly, intrinsic value promotes a long-term perspective. Investors focus on a company's fundamentals rather than short-term market fluctuations. This can lead to more stable and profitable investment outcomes. Understanding intrinsic value is beneficial for all investors. It provides a solid foundation for making investment decisions. Now, let's look at different methods to calculate intrinsic value. The discounted cash flow, DCF method calculates intrinsic value by estimating future cash flows and discounting them to present value. This helps understand a company's worth based on future earnings. Estimate future cash flows and apply a discount rate. This rate reflects the time value of money and investment risk. Sum the discounted cash flows to get the intrinsic value. Despite its complexity, DCF is widely used for its detailed approach. Section 5. Dividend Discount Model or DDM. The dividend discount model is used for companies that pay regular dividends. It calculates intrinsic value based on the present value of expected future dividends. This method is simpler compared to the discounted cash flow model. To use the DDM, estimate future dividends and choose a discount rate. Then calculate the present value of the expected dividends. The sum gives the intrinsic value. It provides a clear picture of what the stock is worth based on its dividend payments. Now let's look at the asset-based valuation method. Section 6. Asset-based valuation. The asset-based valuation method focuses on a company's assets. It calculates intrinsic value based on the total value of a company's assets minus its liabilities. This method is straightforward and useful for companies with significant tangible assets. To use the asset-based valuation method, you need to list all the company's assets. These include cash, inventory, property, and equipment. Next, subtract the company's liabilities. The result is the intrinsic value. For example, suppose a company has total assets worth $500,000 and liabilities of $200,000. The intrinsic value is calculated by subtracting liabilities from assets, resulting in $300,000. This method provides a clear snapshot of a company's net worth. The asset-based valuation method is particularly useful for asset-heavy companies. It provides a tangible basis for calculating intrinsic value. However, it may not fully capture the value of intangible assets like brand reputation or intellectual property. Understanding the asset-based valuation method can aid in assessing companies with substantial assets. Now, let's discuss why intrinsic value matters for investors. Section 7. Why intrinsic value matters for investors. Intrinsic value is a critical concept for investors. It helps in identifying investment opportunities and avoiding pitfalls. By focusing on intrinsic value, investors can make more informed decisions. Firstly, intrinsic value helps identify undervalued stocks. These stocks are trading below their true worth. Investing in them can lead to significant gains as the market eventually recognizes their value. Secondly, intrinsic value helps avoid overvaluation. Overvalued stocks are trading above their true worth. Investing in them can be risky as their prices may fall to align with their intrinsic value. Thirdly, intrinsic value promotes a long-term perspective. Investors focus on a company's fundamentals rather than short-term market fluctuations. This approach leads to more stable and profitable investment outcomes. Understanding intrinsic value empowers investors to make rational decisions. It provides a solid foundation for investment strategies. Now, let's explore a real-world case study to see intrinsic value in action. Section 8. Real-world case study, analyzing Apple Inc. Apple Inc. is a well-known company with a strong market presence. Let's analyze its intrinsic value using the methods discussed. Firstly, let's use the DCF method. Suppose Apple's future cash flows are estimated at $50 billion annually for the next 5 years. Using a discount rate of 8%, we calculate the present value of these cash flows. The sum gives us an intrinsic value that reflects Apple's earning potential. Understanding intrinsic value through real-world examples enhances its practical application. Section 9. Conclusion. Becoming a more informed investor. Intrinsic value is a powerful tool for investors. It reveals the true worth of an asset, guiding better investment decisions. By understanding and calculating intrinsic value, investors can identify opportunities and avoid risks. This guide has explained intrinsic value and its importance. It has showcased methods like DCF, DDM, and asset-based valuation. A real-world case study has illustrated these concepts in action. Recap intrinsic value helps identify undervalued stocks, avoid overvaluation, and promote long-term investing. It is crucial for making informed and rational investment choices. Encourage readers to learn more about intrinsic value. Becoming a more informed investor leads to better financial outcomes. Dive deeper into these concepts and enhance your investment strategies. By focusing on intrinsic value, you can unlock hidden treasures in the stock market. Happy investing!